we stand? It's been 6, if not 12 months since the last time we checked in. And where are we?
Well, the regional, luckily we're not in March of last year.
Yeah.
That's the good side of the story. However, we do think that there is a cohort of roughly around 120, 130 banks. And I'm thinking here about banks between the size of 10 billion and kind of the super regionals, if you will, that will have a little bit of more difficulty adapting to, a different environment. And what I mean by different environment, first and foremost, rates keep staying high, which means that their funding costs are elevated because they cannot pass fully that funding cost into their depositors. Depositors cannot have other options in this kind of environment, like the money market fund. So there's competition there. So profitability that historically was very strong for these banks is not there. Secondary, this cohort of banks has a higher concentration of commercial real estate. One interesting statistics that we shared with you is that this cohort of banks, particularly roughly around between 10 and 250 billion, increased their concentration of commercial real estate between 11-12% 10 years ago to 18% of total assets.
That
so
was
CRE
surprising.
is the golden class, if you will, where they grew, and unfortunately not favorable now.
Was that prior to what happened with the banks last March, or was that even since that they've increased their exposure to commercial real estate?
This is prior. There hasn't been material increase, but definitely I would say the last 5-6 years before the events of last March have been the golden class. We were in a zero rate environment. The economy was doing great. The cap rates were favorable. So a lot of the commercial real estate ended up on banks' balance sheets, and roughly half of the $5-6 trillion, depending how you define commercial real estate, is on banks' balance sheet. And as a matter of fact, 40% is in this bank cohort, which I call medium-sized banks.
A lot of people have said, commercial real estate, it's like the Chicken Little. The sky is falling, but the sky is never going to fall.
Well, that's not necessarily the case because you have to think about layering of risks. Not all commercial real estate assets are, bad, but nevertheless, office, which would deem around, anywhere depending on the definition of office, $300 to $500 billion is certainly very hard to refinance these days. So what are banks doing? They're basically extending the agreement. A total aggregate of refinancing 2024 is a peak year, in particularly in office. There is roughly $1 trillion of total CRE for financing. 20% of that is office, and another $500 billion next year. And in this kind of environment, not any, banks do not want to extend unless they have to. The non-banks also are concentrated in this asset class. So basically, if you want to kind of manage your risks down in commercial real estate, you have to sell it at significant discount.
Yeah, that's what I was going to ask you. So let's say you're one of the names. There's a few different kinds of firms on this list. WaFd's on there, Bank of Hawaii, a couple of Hawaiian banks. I mean, what do you think they should be doing right now in order to shore up their balance sheets? If one of the variables is the Fed, if they're going to lower rates, I guess everyone starts to breathe a sigh of relief. And maybe not. Maybe the office issue is just a secular problem. So what could they be doing right now other than if they don't want to sell at fire sale prices?
So what we're seeing is, capital preservation, liquidity preservation. There is no clarity yet on the capital rules for these banks. There are a bunch of proposals that potentially would make, capital rules more stringent. In addition to the commercial real estate, there's another $500 billion of unrealized losses still from the securities portfolios in the regional banks cohort. So there is a layering of risk. The bank is very hard at this point where I'm going to deploy capital to maximum returns. So this is where private credit becomes an interesting proposition. And what we've seen is that there's partnerships potentially in the works where the private credit lenders can come in, of course, at a price, take maybe a super senior tranche loss in this portfolio, be paid for it, but then the bank retains a better, if you will, risk tranche of these portfolios, but still maintains the customer. So we believe that this is what we were talking about, golden age of private credit, and you and I talked about this maybe 6 months ago. That was in the direct lending space. A lot what we're going to see now is in other asset classes expanding, where private credit has capital, they can come in, they can securitize, take that, those assets from banks' balance sheets, of course, at a steep price.
All right, Anna, thank you for joining us to explain it. We appreciate your time today. Hope to check back in soon.